What's up, team? Sean from Invest to Live here. And at the request of a whole bunch of different folks, I made a pretty comprehensive video covering moving averages today. So I'm going to jump right in a quick second here, but what I really want to call out before I even do that is this. This is one of the many tools you should have in your toolbox. You should absolutely learn what moving averages are, why you use them, how you use them, where you use them, what the different types are, and what they mean. I'm going to cover all of that. What I really would urge you to do is watch the whole video, not because I'm worried about watch time or getting you to see everything I have to say, is that you really have to understand how different pieces move into each other here to get a full and complete view. If you are an investor, a trader, you're day trading, or looking at 10-year trends, both of what the things I'm going to show you today work right here. And it's really important that you give yourself the skills and the tools to be successful in the realm of investing and trading. It's on you ultimately to do this. I've put it together in a really simple way today. I'm doing it on PowerPoints, which I never do, but I decided it would be a great way to do this because it's a lot of information. It can be complex if you don't understand the different ways to do it. And I'm going to talk about how I use it within my own portfolio, and I'm going to show you how to use it on a really popular shared charting service. So with that, I'm going to share my screen and jump right in. But seriously, this is not one that's worth watching for 5 minutes. If you want to learn how to be a better investor and a better trader, you need to know how to do some degree of directional based technical analysis. So that's what we're going to cover. So I'm going to share my screen and I'm going to get rocking and rolling here in just a second. So let me do that. Let me switch this to presentation so everybody can see it. So real simple, here's what we're talking about. What is a moving average for investing? Because moving averages are mathematical formulas in the world of statistics, but a moving average for investing is a little bit different. Same formula, but different applications. Let's jump right in. So first and foremost, right, I'm going to be using the term MA a lot of times in these charts here to stand for moving average, just FYI. I'll call out if things are different there, but it was just a way to save some space on the slides. So what is a moving average? Okay, in its most simple, easy way, it's a technical analysis technique or tool that allows users to smooth out constantly changing price action. So if you're new to the realm of investing or trading, or even if you're not new and you've never used technical analysis before, sometimes you can look at a chart and there's a lot going on. There's red, there's green, there's ups and downs, there's lines, there's bars, there's all these different things. This is really a way that you can overlay this view on top of a chart and give you a really smooth line that lets you know what is happening, what is the directionality that things are moving in. So the idea here behind a moving average is that we want to smooth out the data the best way we can using these different formulas to give us an updated or near real-time average price for the stock over time and how that's changed. Because during the day, we get lots of different things happening. It's important to know, though, where we actually stand. Now, in one way to think about this is we're really looking across this at different time periods and different charting time periods. We'll get into that a little bit later in the video, but I want to call it out that the metric we're often talking about when I say things like a 10, a 50, a 200, right? These typically stand for periods of time. So just keep that in mind. And the beauty of the moving average in general is that whether you're a short-term day trader or trading by the week, or you're looking over 5 or 10 years, moving averages work great for both scenarios because they have purposes in doing it. And because you can change the view of a chart and the time period you're looking at and still get a lot from moving average, there's a ton of value to be had here. Now, why do we use them, right? Why is this something that we hear about all the time in the investment community and the trading community? Well, because they're really easy. They're automated. They're typically easily accessible from our brokers or from our services or any free charting provider for that matter. They're something that anyone can look at, have a basic understanding of, and be able to take action on it, knowing that, hey, this provides a little bit extra technical analysis to what maybe my fundamental analysis is, maybe what my economic belief is, and where I think we're going. So here's why we use them. It's pretty simple, right? I'm trying to identify things like trends. Also the directionality of those trends, right? Are they likely to change or not? I'm looking for support levels. I'm looking for resistance levels. I'm looking to identify signs of a trend reversal before anyone else does so I can shift my positions, get out of something that might lose, take a profit. I'm also looking to identify warning signs. I believe something's been going way up and I'm in it heavy. Maybe I want to start to position a new hedge, or maybe I want to jump out and take my money out before that trend reversal happens. Those are the warning signals I look for often myself. And then additionally, one of the greatest things we look for is just more trade signals. When should we be getting in? When should we be looking for opportunities? How do we do this? And I'm going to get into this towards the end of the video, but really crossovers are such a great way to find opportunities in the market. That's why I'm saying if you're going to watch this, watch the whole thing. It's going to be worth it, I promise. Now, what are some of the other reasons we use moving averages, right? Let's continue from the previous page here. Charts can be very, very complex. They move really fast in real time. And for many folks, they're just darn hard to understand. You know, one day we're down 200, the next day we're up 400, right? Well, why? What changed? What can we pick up or learn from that, right? Moving averages help to lower the noise level or the screaming from a million different signals coming at you in a chart. It helps to just quiet all that noise down and let you see how things are flowing over time, right? What the average movement looks like, getting away from all the extremes. And it helps anyone at any level of their career or experience level here to get a basic view of, look, what has been happening? What is the trend we're seeing? What direction has the trend been moving in? And are there any blips on that radar that might indicate something could change? Now, the other beauty for me of moving averages, and this is one of the first things I learned going back now over 20 years as an investor, I loved how easy a moving average was to overlay onto a chart. It helped me just quickly ascertain what's happening in seconds. It's really that simple, right? So when I say we look at quick views around directionality, here's what I'm looking at, right? Or do we see upward moving lines that are indicating prices should be increasing? Are we looking at downward moving lines that indicate prices are moving downwards? Seems simple enough, but sometimes when you look at a chart, it can be very hard to get that from it when there's highs and lows and ranges. That's why this is so great, is it will really help to call out those trends and those lines. And if it's moving sideways, maybe we know we're in a range-bound pricing period, and that's something I want to pay attention to as well. Now, one thing I want to call out here, because I think a lot of folks get very lost in this piece of it, even the most real-time charting can still oftentimes have what we call a lag, LAG. I'm going to talk about it later on as well. But the reason I'm calling this out as a caveat is spend the time to practice reading the charts, understanding how moving averages work. I would start doing this every day, right? Just lay one over any chart that you're looking at, and I'll show you how to do this as well. And start to get a feel for how long it takes for a price to change before moving average actually picks it up. And you can learn what those early signs are as well. Because even real-time pricing is going to be hard to find from a directionality perspective instantaneously. So again, it's important to know what that looks like and be aware of it. So let's talk about support and resistance. And I'm just going to move my little picture here because it's blocking my view. Oops, sorry about that. Oh my gosh, guys, I'm sorry about that. So let's talk about support and resistance, okay? Because support and resistance are major things when we talk about technical analysis. They're great indicators of what could or likely is to happen. And they also help folks like myself understand if I'm in the position the right way, am I sized correctly? Should I be watching out for something else that maybe I'm not quite aware of? Just little things that I like to use in my own trading, my own investing, etc. here. And if you do follow my 100K options challenge, this is a lot of what I'm doing to understand if I feel comfortable making a trade or selling a put in a certain market. In fact, this is the only technique I use, frankly, other than my own research on those companies. So let's jump into support and resistance. Moving averages at times can do a lot more than just directional understanding of a price, right? In this case, I said a stock price as an example. Now, of course, we know we're talking about trends, we're talking about directionality, but oftentimes what we can find within a moving average is we get these things called support, we get these things called resistance, okay? The easiest way to think about it is like this. Support is when we have a floor on pricing, right? Let's say we have a stock that's trading over 100 long-term, and we know that every time it gets close to going down to 100, it bounces back off that $100 mark again. Think about that $100 as a floor. Now, simply looking at a chart, it would be really hard to understand with your own eyes, well, what is the floor on pricing? Well, by using a moving average, it helps us to identify a floor over time, because where we have that line, we'll see that stock price above that line. So I spelled it out here really clearly, I hope. In markets with uptrends, the moving average can act as a lower bound where the price might, likely, should, use any word you want there, be more likely to bounce off and continue to rise. This is really important so you don't sell profitable positions too early. And it's also important to know that maybe it's time to jump in and add more to your position if that's something you're interested in doing. Now, let's talk about the total flip side for a second. Resistance. Resistance is when we have a ceiling on pricing. This, in that $100 example, we could have a stock that keeps getting close to going over 100, and every time it gets there, drops back down again into those 90s, right? And this is the same exact thing as before, but quite literally the opposite. In markets seeing downtrends, the moving average can act as a top for pricing, and we'll see subsequent bounces back down on those prices. Again here, this is a good sign for those who are looking for a position where if it does eventually crack that ceiling, maybe that's a sign of very bullish things coming, right? That price could explode through that resistance level. This is what a lot of traders are looking for in real time, is opportunities to break that resistance level and then start to really skyrocket. And it's just good to be aware in both of these that this is a tool in your toolbox, right? And things can always change. You can get false indicators and false signals. But as a general rule, I treat this as a way to get me more information in an easy to understand way to help me identify possible opportunities, possible trades, possible things to be concerned about, et cetera, right? So that's why I really want to double down on that message, that this is about adding more opportunities for you to look at in a quicker and easier format. And I called this out here at the bottom. I should have just read it right there, I suppose. But really the reality is this is not a full decision process. Just because a moving average tells you something doesn't mean you should immediately act on it, right? You should build a plan around what happens when things happen. If you see it bump over that, in the example of breaking resistance, if you see it blow past that $100 mark and then blow past it again, maybe that's a sign that we've broken resistance twice and we're likely to get well out of that sort of downward trend and back into an upwards or even range bound trend. So just know the way these things work, and it's easy to go back and look at time and how things have changed as well. Okay. So we've talked a little bit so far about moving averages, but to be clear, a moving average is really a mathematical formula. What are the ways we think about it in terms of how we approach it from an investing or a trading perspective? Because let's be frank, that's what's really important here. So it's pretty simple though. That's the beauty of this again. There's really only two types of moving averages that we're going to be discussing ever when it comes to technical analysis. Not to say there aren't deviations or variants that exist, but I don't think you need them. And I think very few people need them. And I don't even think algos or quants are using them. So here it is, really simple. We have simple moving averages, often known as an SMA. We have exponential moving averages, often known as an EMA. A simple moving average is exactly as you would imagine. It's a mathematical calculation that looks at different time periods. This could be 5, 10, 50, or 100 days, or any numbers in between there. And it's going to calculate averages for those days. So to really break it down and make it even easier, let's just use that 20, right? A 20 days an example. The simple moving average will take the 20 most recent daily closing prices and then divide that number by 20 to create a new daily average price. And then that will automatically be charted to get that average daily price and how it's changing over time. Because that average gives us an ability to look at what kind of a trend we're going on, not just highs and lows, not just differences in highs and lows, but really getting a feel for where things are over time. It makes it easy to understand that average price. Now, in this particular formula, each average price is then connected or associated to the next average. We end up with this simple singular line that flows over your charting. This helps to really clear out those extremes, those gaps in prices, those big moves down, those big moves up. Because at the end of the day, we're trying to find directionality at all times. So that's why the simple moving average is so good at this, because all it's doing is really just simply looking at those averages, tying them together, and presenting them in a simple single line on your screen. Now, an exponential moving average, this takes the calculations a bit more advanced, right? We're going to go a little bit deeper into the way we do things here. But again, the good news is you don't have to do these calculations. It's done automatically with your charting software that's typically included with any of your brokers or any of your apps. So an exponential moving average or an EMA is much more complex than an SMA. But for all points in clarity here, you don't really need to know that much about it. I'm happy to go into the deep weeds of it, but even I don't do that work. So I don't think anyone else needs to either. Now, what's different is in the EMA model, we put more strength or more weighting on the most recent pricing, because in this model, what we're saying is like, hey, the pricing from days ago, weeks ago, years ago, it's important to know those numbers. But the most recent period of time, those most recent average prices are more likely to have a heavier weighting on what happens in the subsequent days ahead. Now, this doesn't necessarily mean it's better or worse, but I do want to call out a point here that I think is really important, and this is going to really have a lot to do with how you trade and what your time horizon is that EMAs generally will react or reflect pricing changes quicker than an SMA due to the heavy weighting. So it's not going to be as considerable or put as much consideration onto those, further out periods of time. Those most recent periods of time will help to derive that quicker and give you a better reactionary period from the standpoint of how we chart this and overlay it on a graph. So if you're saying to yourself, well, I don't really know which one to use, I think what you have to do is look at your style, look at how you would practice with these on a really simple charting service. And again, I'm going to show you this. And just get a feel for how you read it, how comfortable you are with understanding what they mean. And then also understand that if you're trading shorter term, just my opinion here, I think shorter term, I like to look at EMAs or exponential moving averages. For longer terms, swing trades, big moves I'm making that are counted in months or years, I think simple moving averages are okay as well. You don't need to go too crazy here. Because at the end of the day, what we're really looking to do is identify, again, those simple things: trends, direction of trends, resistance or support, etc. So that's why it's important to know the differences. And again, in short-term trading, we're looking to get quick reactions and quick price change reflections. That's when EMAs come in to be very handy as well. And I kind of threw this in here because I wanted to take a pause in the video just to say, look, there's really good news here. These are very complex, strong formulas for helping us get good technical analysis on the pricing of the assets we're looking at. But even better news than that, you don't have to know how they work. You don't even have to know how the math works. All of these brokerages, and I've said it a few times, I'm saying it again, they make it really easy not only to deploy moving averages, but also make changes, view them in different time periods, etc. So that's the beauty of all of this. I'm going to show you how to do it in a free Yahoo chart. You don't even need to log into anything. It's going to be a super simple way to do it. And what's more, many of the brokers out there, especially the more premium brokers, not so much the discount brokers, but they'll even offer free training. They've got videos on how to do this. They've got videos on how to do other technical analysis techniques. And although I'm not going to get into it in this video, moving averages are often the sort of appetizer to technical analysis. So if you get really strong here and you really like working with moving averages, you can then take it and move it into other forms of technical analysis. Oftentimes you'll see like an MACD is the next one up, but I'm not talking about that in this video. So let's keep going. So we've already talked about this briefly, but I want to double down on it again here. Should you be using an SMA or an EMA? It's a really fair question. I've been hearing it for 20 years. I ask myself this question all the time. And what I do is I simply back test my strategy and my time frame to see which one's going to work better for me and cause as little noise as possible while still giving me the directionality that I'm looking for. And I think the simplest way to put it is either are generally going to be okay. Unless you're running really short-term algo-based trading with real-time hookups to these moving averages, you're probably okay with either. But I would say to really delineate as simple as possible, I prefer EMAs for near-term plays. Again, if you follow my selling put strategy, I use EMAs to find near-term directionality or resistance and support levels because I only trade 1 week out from when I make those trades. I, on the other hand, though, prefer SMAs for my longer-term, for my longer-term trend finding if I'm doing things like buying calls or leaps for that matter, or even if I'm just looking to go long on certain equities. So my advice, and take it as you will, it's just my opinion, is get comfortable with them both. But if you think one makes more sense for your style, really double down on it. Learn how it works. Learn how to get better at it. Learn how to find the opportunities that live within it. I think it's on you ultimately to really do that. Now, let's talk for a second about this idea of time length or how we include time in this, right? So in terms of any moving average, we're looking at those time periods to indicate how many days or periods of measurement we're getting those averages from, right? The most commonly used time periods across the better part of decades here is 10, 20, 50, 100, and 200. Although I'm not going to cover this at length because I don't want to make this too confusing, what I like to do is combine typically a very short period with a moderately short period and then a long period. Because what I'm looking for is sort of near-term changes in price, but buoyed by that long-term directional piece, right? So I might take like, a 10 and a 50 and also a 200. If I start to see that 10 and the 50 coming close, that's indicative that something might be changed in near term in price action. But that 200 is really that long-term, big yearly view that I'm looking at in my account. And I want to make sure, hey, look, even if there's some near-term price movement, which might mean I can make some opportunities for myself, I want to make sure we're still bullish, we're still bearish, we're still in a range, whatever the case might be. So the good news here, though, also is that these work against any kind of charting time frame as well. So if you're looking at a minute chart, an hourly chart, a daily chart, a weekly chart, MAs are still going to work well for you. Now, the big call out here is your time horizon should be the driving factor for how you use these numbers, right? We've covered this a few times. I'm going to say it again. If you're looking to make trades intraday, you want to be able to execute very quickly on price changes. If you're looking for long-term moves, major moves in the market, SMAs are probably good for you there as well. And those 100 and 200 levels are going to be really indicative of what you're looking for too. And I want to call this out when you're starting to practice with this. Long-term time frames are going to generally be pretty smooth, right? Those lines are going to just sort of like float on into a direction, right? Very little movement on them. But short-term moving averages, you could look at a 5, a 10, a 15, a 20, whatever the case might be. They can cross over, they can be choppy, they can do lots of different things because they're reacting very quickly to those near-term pricing changes. And especially with the volatility that we're experiencing in our markets the past few years, those short-term indicators can at times make it very hard to interpret what's happening and oftentimes throw false signals. So learn to understand and recognize what those are and what that means to your portfolio as well. Now, I spoke about this very briefly earlier, and I want to speak about it one more time because I think it's really important to do so. Lag is something you have to consider anytime you're using technical analysis. No matter how good the tool is or how quick it updates, there is always a lag between what is happening and how soon you're able to interpret it and act on it. So lag is also, I guess I'm going to just read what I wrote here, but it makes sense for me. Lag is very important as it's the true representation of when a moving average indicates a reversal of price versus when the signal becomes clear. Something can change price and it might take a little while for it to become obvious in the charting. So learn what those early signs are as well. It's a lot. I know this is in theory a lot to learn, but the beauty of it is it's not. You just have to start practicing overlaying moving averages on different stocks that you like. And if you really specialize in, a basket of maybe 3, 4, 5 stocks, it gets very easy to apply these and see how they react to news, react to earnings, react to different things that happen. So get used to it, start doing it more often, and it's going to really pay you back truly in profits down the road. Now, the number one reason why most of us use technical analysis tools like moving averages is because we're trying to find an opportunity to make some money. So the number one strategy I use, many others that I know use, I think probably in the entire space, frankly, is this idea of a crossover or crossovers for that matter. This, as I wrote here, is generally the top strategy used with moving averages. So the crossover in the most simplistic version that I can share is when the price quite literally crosses over the moving average line. So if you think about your moving average as a line and your price has been up here, when they cross over each other and now the line is above your price and the price is down below, that is literally a crossover. Your pricing has crossed over or under that line. Okay, so I want to call this out here. This crossover could and many times will explain, show, or indicate that there's a reversal on price or even that there's a new trend that could be starting. This is going to be heavily dependent on the time frames you choose for your moving average, as well as the type and time frame of the chart you're looking at, okay? But overall, when we do see those crosses, it is indicative of a change is happening. And again, I've doubled down on this. I'm going to triple down on it because I think it's really important for everyone who's watching this to understand that you really need to get good at understanding a false signal and look for confirmations. Oftentimes, I think about it like in the early example when we talk about resistance on that $100 level. In those cases where maybe you break through resistance and you come back down, if you break through it again, maybe if you see it 2 times or 3 times, depending on how you approach it, that might be the opportunity to really understand and act on the fact that, hey, this is a real move. It's been confirmed 2 or 3 times. I'm ready to make a play on what's happening here, okay? And I want to call this out that my top strategy in my own investing is to use multiple moving averages overlaid on the same chart. So what I do is simple. It could be 2, it could be 3. And I think this is the way most folks do it as well in terms of being a little bit more complex, but still easy to understand, is what we'll do is use either 2 or 3 different time periods and let those act almost as even earlier warning signs than a true crossover of the underlying equity that we might be looking at as an example. So in this case, I'm assuming we use sort of a shorter term moving average of like a 20 and a longer term moving average of a 200, for example, right? Now, I want to call this out and make it super simple to understand. If a short-term moving average crosses above the longer, we would have a buy signal as it shows a trend that is likely to have confirmed a shift upwards. And this is typically known as a golden cross, okay? So I want you to think about this. This is the case that we have the 200 moving averages here, the 20 is here. If that 20 crosses above the 200, this is a buy signal and called a golden cross. It indicates a strong move that we're seeing a shift upward or a trend that is likely to have confirmed to make that shift happen. Now, the exact opposite can happen as well. If that longer term moving average crosses over the shorter, we have a heavy sell signal, and this is often known as a death cross. Now, it is very important to understand that things can in the short term, these things can happen and reverse quickly. So this is why it's important to confirm those moves. But I do want to call it out here that these are typically industry known big things that when you see short-term and long-term averages cross, something is happening, and it's on you to understand what that means, okay? So let's wrap it up here, right? Moving averages are really great for helping you identify certain things like trends, the directionality of those trends, where resistance or support might live, opportunities that are out there within lots of different asset classes to jump in, jump out, be aware of, confirm, take action on, etc. Simple moving averages and exponential moving averages can be used in most cases with really only some differences coming into play based on those time periods, right? Those really short or versus really long. And it's still on you to understand which ones are going to fit best for your version of trading or investing. I did want to throw in a couple extra words of caution here, right? In very, very volatile markets, moving averages can overreact, especially when we're talking short term. If we have earnings reports that throw wild numbers out that weren't expected, this is going to throw everything out of whack. And it's important to know that moving averages can be wrong in those cases. They might overreact, might be too choppy or too volatile. So recognize also that there are external events that might be happening that are throwing your charts off, and know when to step away and not take action, and recognize that there's an external factor there, okay? And what can happen for a time period after this is you might get unclear action within the underlying security. Oftentimes you'll see it rising and falling above and below that price action, right? So it's okay if you're a short-term trader and you're looking for that, that's great. If you're a mid to long-term trader, that's a warning sign. You're going to want to be definitely avoiding that. So what I want to do is switch over real quick to a simple chart here. I'm going to stop sharing my screen for a second while I pull it up here. And I wanted to pick something that would be like, I don't care who you use, where you go, this is a great way to practice it, okay? So I'm going to share my screen one more time, and I'm going to pull up a real simple example here in Yahoo Finance. I think a lot of people use this. I think this is a really good free place to go to fool around. It has no impact on your brokerage or your own charting. I, of course, encourage you to use your own broker, but just something I knew anyone out there could absolutely come here and practice this with. I chose to show you guys this on Yahoo Finance, and I'm going to show you the easiest way to get started here. I chose Tesla because it's, number one, a really popular stock, but also because it does have a lot of price movement over time with averages that can be blown way in and way out depending on those big price moves here. So now I'm in here, I'm in Yahoo Finance, I'm looking at Tesla. Its most recent price as it closed was at $1,005. Obviously, we see it actually dropped a little bit after hours, but inconsequential to the point we're making here. So what I want to do is I want to click right here on chart, excuse me, and what I'm going to do is, I'm just going to get my screen to the right place so everyone can see what's here. I'm going to call it a couple of things here, right? I have this set to a 3-month view. Let's start it with a 1-day view for the sake of conversation, right? We see when the market opened to when it closed for the day. This thing really was all over the place, right? At one point we were down, looks like under 1,000, all the way up to, let's see where we are here. We had a high of 1031, a low of 1025 at this time period, right? So like there's a lot that's going on. When we switch to a 5-day, oh my gosh, right? Like look at these huge moves. How the heck can you look at these charts and get any kind of directionality on what to do here? Well, again, the beauty of this is that even free charting, and I'm going to actually switch to full screen here. That's what I meant to do, and I didn't realize it. Even when we're looking at free charting just on Yahoo as an example, right? Look at what we've got here, right? We've got all these different things we can look at. We've got the different time periods of charting, right? We've got year to dates. We've got long time periods. We've got short time periods. The beauty of this is it's so easy to move a moving average onto this chart. Like, check this out. Click on my indicator button here. We see, right, moving average. I'm going to click right on moving average, and it's going to let me decide, do I want a simple or an exponential, as well as all those others I mentioned that exist, but we're not going to talk about. Let's just keep it on the simple, and let's pick a period of that 50, okay? I'm going to save this, excuse me. And now what we have here down below is you can see this purple line down below, which is representative of the 50 day simple moving average. We can see here that it is below the line, which indicates that we are in a bullish trend with Tesla over the 1 month period. Let's switch over to 3 months. Well, we can see here we had a crossover event, right? This is just how you learn to look at this in a simple way. We experienced a crossover on 3/18, so March 18th, where suddenly there was a significant jump in average pricing, which led our charting to give us a heads up here that this thing could be moving back into a bullish time period. So even if you took a few days to take action on this, right, and you jumped in at, say, 993 a couple of days later, well, you would still have made a ton of profit here as it jumped up in over $1,140, right? And even as it stands today, you're still within the profit, within the range of our profit. Now let's switch over to 6 months, for example, right? You can see how this starts to get really flattened out, really smoothed out. When you look at all of the wild price moves of Tesla, our simple moving average, right? It's just giving us those directions when we're up, when we're starting to move down, when things are moving back up again, right? And I always think that Tesla's a great example because it does experience wild price moves. But when you get good at this and you get good at understanding what happens within these changes, if you were to make a move within even a couple of days of confirming a signal, look at the amount of upside you would have had, right? And even if you took a few days to recognize some downside, there was plenty of downside profit to be had. And when that move happened again, you're still going to be up in that upside yet again. So the reason I want to share it on Yahoo Finance and give you an easy way to play with this was, this is completely free, a couple of clicks, everyone has access to it. It's so easy to play around and mess around with it as well. And if you feel like you can actually start to do different things, right? You can draw additional lines. You can create your own lines on the chart, right? Sorry, I'm clicking all the wrong buttons here, right? It starts to let you have a little bit more fun with how you learn technical analysis, how you can see how things change over the different terms. And for me, it's just a great way to learn something new. So look, that's it. That's moving averages. It doesn't need to be overly complex. It doesn't need to be years of advanced training. It doesn't need to be MBAs and experts in financial analysis. Anyone with an internet connection can go to Yahoo and start playing with moving averages, simple moving averages, exponential moving averages. You can pick the numbers you want to look at. When you get comfortable with how that works, you can easily add a second moving average or even a third and start to see how those short terms cross over each other. You can start to see, when did a golden cross or death cross happen? What then happened after that, right? And it's important to understand, when did you get a false reading? When did it think something changed and didn't, and what led to that? So that's it, team. I hope you got a lot of value from this. I hope you watched the whole thing. And please, please, please let me know what you think. If there's parts that I can come in and do a quick video to clear up, I'm more than happy to do it. If there's parts that you think were just too complex, let me know. If there's parts that were too simple, let me know. I really, really appreciate you watching. I made this video in response to a number of folks who had reached out and said they wanted to get my take on moving averages and how I apply them to selling puts in the near term. I wanted to do it a little bit bigger than that, so hopefully you got a lot of value. And again, please let me know what you think. So with that, thanks so much. Good luck out there. And look, if you're watching this, you're already doing a good job because you're trying to get better at trading and investing. So good for you. Thanks so much, everybody. Have a good one.